let's talk about sort of 20 years. And what do you think it means?
Well, it's what started out as an incredible innovation at the time, and people were, is it going to work? Is it going to be successful? And 20 years later, it's $66 billion, and it's been amazing for the investors. And 10th year anniversary of a bull market, and you've seen almost 19% annual compound growth rate. So it's really a great way for people to invest.
What do you think? If we were sitting here 20 years from now, how much more of the business do you think is going to move into the ETF world?
Yeah, it's a very common question. I think it's an incredible vehicle. Obviously, you've seen the growth has been amazing. That'd be very topical for people to focus on, but there are other vehicles and other ways to manage money, and I think the vehicles will continue, mutual funds, separate accounts, they're all going to continue to
but do you think that passive investing will be an even bigger slice and piece of the business?
I don't, and I say that
Interesting.
From where I'm cap-weighted indexes in particular, I think what's going to continue to grow quite rapidly is really factor investing, smart beta investing. A lot of that ends up in ETFs.
And what about people who are effectively actively managing money through ETFs?
So it's going to, the way that we look at it and what we're seeing is it's going to continue to be a very important component of how people manage money. ETFs, mutual funds, separate accounts. So I think they're all going to really be quite successful.
Do you have a different take on that? I think you think more passive, right?
I think that basically we're seeing that there's a balance in the system, but at any time it becomes imbalanced, meaning if there's too much index investing and not enough individual investing, then there becomes arbitrage opportunities in the market.
Do you think there's an imbalance right now?
So I do. I actually think that right now it's pretty well balanced, but you could say that there have been shifts in liquidity around the fact that the ETFs have become as large as they've become. At the same time, I think that that for individual investors and individual stocks, it's a pretty efficient market as well. So I think that right now it's probably operating at a pretty good balance.
Do you go ahead?
Can I add? So what I'm trying to differentiate is there's so much money in cap-weighted indexes right now, and that's really what's happened since March of '09. And I think there's too much in cap-weighted indexes right now.
Do you believe if there is a crisis, I hate to use the word crisis, but if there is, that the way all of these ETFs will trade will create a problem, a downward spiral?
I don't see that. I mean, look, I wouldn't just look at ETFs. I would look at any vehicle over history, and the assets have been managed. We've gotten through them every single time.
But do you think that it will exacerbate the problem, if and when?
It's hard to know whether or not it will.
I think that you might see some short-term dislocations in stock prices, as if you have kind of a big run out of a particular ETF, whether it's a smart beta ETF or a cap-weighted index, where you might have some short-term dislocations, meaning that the selling behavior is not necessarily reflecting the fundamentals of the company. But I also believe that the markets are pretty efficient, and investors will come back in to kind of create that balance. But you might see some short-term dislocations if you see, particularly, kind of what I would call herd level kind of selling activity.
Can we talk about this SEC investigation in terms of pricing on exchanges? Right now, there is an inquiry that's taking place about how you price trading to the various brokers and banks, right? Is that the best way to explain it?
So I would say what you're talking about, it was in an article that we have not validated.
What does that mean, you haven't validated?
Meaning we read it at the same time you did.
So what do you know about the investigation? Beyond what you've read?
We've read it the same thing that you've read.
Okay, let's take on face value that what we read then is accurate, just for a moment, which is to say there is an argument that has been taking place on Wall Street beyond this article that the exchanges offer different pricing mechanisms for different types of brokerage houses, different size traders. Is there an argument? I mean, the argument is that smaller brokers are being disadvantaged relative to larger brokers. Speak to that.
Okay, so basically, exchanges are obligated to provide the same pricing for similarly situated clients. So we are not allowed to give anyone a special deal. We're not allowed to do any sort of discounting, bundling and discounting of products or services. We have to, and every single one of our fee filings is filed with the SEC and approved by the SEC. So at the end of the day, we look at the only mechanisms we have within one exchange is to offer essentially some level of volume discounting that might occur that is approved and sanctioned by the SEC. And that's the only thing that we do that I would say kind of creates differential pricing. Whether if you're a big volume player, then you might get different rebate structures.
Are there some players though that are paying virtually either nothing or less than nothing to trade with you?
It depends on their behavior. So it depends on whether they net adders or they net takers. I would say honestly, they pay the exact same amount to take as everyone else, and they get the same amount to add as everyone else.
What do you mean by that?
Well, so the market is this is a very esoteric situation where basically the way that we work is if you are providing liquidity onto our exchange and you're making your quotes accessible to everyone and you're making it so that everyone can see the liquidity that you're adding, that's called you're adding liquidity. And if you're a net adder, we basically, if that order gets traded against, we pay you. The person who's taking that order and executing against that lit order pays the exchange. So the net of that is we get a very, very small amount of money netted out between those who add liquidity and those who take liquidity. And it depends on the behavior of the brokers. Right. So if they're net adders, they might get more of a rebate. If they're net takers, they might pay more of the fees. But that's basically their behavior. But those fees, the add fees and the take fees, are equivalent to those brokers. We are not allowed to offer any sort of special deals beyond the volume discounts that we have filed with the SEC.